Mike, I'm young, so should I be investing for dividends or should I be investing for growth? Which one should I do? Or should I do both? I literally get this question all the time on this channel, all the time. So let's address it today. Hi, I'm Mike the CPA. Welcome to Money and Life TV, where we teach videos around finances, investing, taxes, and more. Thank you for being here with me today. It really means a lot. In today's video, I'll be sharing my personal perspective and investing experiences around this topic, showing you some examples on screen, and sharing some articles with you towards the end of the video that I would encourage you to check out for yourself. Also, I've put a special bonus in this video towards the end, so make sure you stick around to check it out. I think you're gonna find it worthwhile.
Just FYI, you can jump to or rewind to any point in the video using timestamps Mike has included in the video description and the comment section.
As we are getting started, if you guys could do me a quick favor, if you enjoy this video, make sure you drop a like and comment down below and let me know your perspective on whether you think you should be investing for dividends or whether you think a person should be investing for growth. I would love to hear your thoughts on this topic, and I'm sure the community would as well, so please share those below.
Now, Mike, let's say I'm a new investor. Let's say I'm new to all of this stuff. How do I even determine if a stock is a growth-focused investment or more of a dividend-focused investment? Because I have no clue.
Well, Chipper, the answer lies in the way the company treats its profits. Companies who invest the profit back in its operations or expansion are considered to be growth companies. On the contrary, companies who pay out dividends to its investors or shareholders rather than invest back into the operations are considered to be dividend income paying companies. Some companies pay no dividend at all, and as an example, that would be such as Amazon, Tesla, Facebook, and Netflix. Those are great examples. Those are companies that are 100% pure growth focused because they're investing all of their profits and earnings back into the company's operations. On the other hand, I think you're going to find companies that are taking a hybrid approach, whereby they're still primarily focused on growth and growing its operations, but they also pay out a small dividend to its shareholders. Simple examples of this include companies like Microsoft, Apple, Starbucks. Disney would be another good example of that. Now, when I first started investing, this stuff was super confusing. I had no idea of a simple way I could classify a company as either growth focused or dividend income focused. So it kind of came up with my own method to determine that for myself. Now, this is just my own rule of thumb, so if you can use it and it helps you, great. If not, just ignore it. But this is, in my mind, in my investing philosophy, this is how I classify a company as either growth or more dividend income focused. So to me, if a company has no dividend yield or doesn't pay out a dividend yield, or the yield is less than 1.5%, to me, that's telling me this company strategy is growth focused. So I'm going to consider that a growth focused company or growth focused investment. Now, if I come across a company that has a yield of 1.5%, even up to 3%, to me, they're taking a hybrid approach, whereby they're paying out they're still growth focused, but they're also income focused. So it's kind of a growth and income combination, 1.5 to 3%. And finally, to me, if a company is paying out more than 3% annually in terms of a dividend yield, 3, 4, 5, 6, 7%, to me, that's more of a dividend income focused kind of company or investment to be invested in. Now, just to put this in further context, when I say that, I'm primarily referring to individual stocks. You can apply this philosophy to ETFs or mutual funds, but realize, in general, ETFs and mutual funds, their average yields are typically lower than individual company stocks. Now, there's no denying it, ladies and gentlemen, dividend income investing has become extremely unpopular in 2019. More so, I think, than ever, as people look for ways to add passive income to meet their long-term retirement needs. But I'm about to give you 7 reasons to consider adding growth-focused investments to your portfolio, even though you might be truly a dividend investor at heart. Now, I'm truly a dividend investor at heart, but there's reasons I add growth-focused investments to my portfolio, and I'm going to give you some of those reasons right now, so let's run through them. So whether you're a young investor or you're nearing retirement, there are still reasons to focus on growth. And let's start with number 1. The first reason to consider adding growth investments to your portfolio is total return. Dividend payouts are great, but what if you had the possibility to get an even higher return on your investment? in a shorter period of time. It's probably something you don't want to ignore if that's a possibility, and it absolutely is. With certain investments that have a growth strategy, you can certainly achieve higher returns on your money. Not every year, it's not going to happen every year, but when it's doing well, it can do very well, where you can get returns of 10, 15, 20, or 30% or even more, depending on the investment itself. And this includes stocks, ETFs, or mutual funds. Any one of those investment vehicles can do it. Check out this graph I'm going to put here on screen. Quick example, this is the Vanguard Growth Index Fund ETF, known as VUG, versus some of Vanguard's very popular dividend ETFs. So the VUG is in the blue line right here, and this is the max time horizon. I know it's not clear from this picture, but over the max time horizon, since these investments have been around, VUG has performed very well at 234% return, whereas if you invest in VIG, which I do personally own, and that's the Vanguard Dividend Appreciation Fund, where it has come through with 162% rate of return over the max time period, and VYM, which is the Vanguard High Yielding Dividend Fund, it has only grown about 100%, or a little bit less than 100%. Reason number 2 is you don't really need additional income right now from dividends because you're really not trying to live off your investments at this point. Reason number 3, growth investments are generally perceived to be a little riskier, which is why you'll often hear out there on the internet or from financial advisors to focus more on growth when you're younger. But this doesn't mean you can't still have a growth strategy within your portfolio if you're close to retirement. You might just minimize the amount that is growth focused. All right, you dividend investors, I think you're going to like reason number 4. Many growth focused companies still pay a small dividend yield, so you can still get your small dividend fix. By the way, it's okay to admit if you're addicted to investing for dividends. It's okay. I mean, I admit it. I'm a dividend junkie myself, and I need my dividend fix.
And now I gotta put up with this too?
Reason number 5, investing for growth won't generate additional taxable income unless you actually sell the investment at a gain. Dividend payouts generate taxable income each year if the investments are held within a taxable account. Regardless if you take that dividend payment in cash or if you reinvest it, you're still going to have to pay tax on that dividend. So if you want to keep your taxes at bay and keep them low, you'll actually want to focus on growth investments and not dividend investments if they're held within a taxable brokerage account. Although dividend payout increases have historically kept up with inflation, growth investments may put you further ahead of the inflation curve rather than income-focused investments. I think you're going to have a better chance of staying ahead of inflation with some growth in your portfolio. And reason number 7, I've saved the best reason for last. I know several people who are doing this, including myself, and what you can do is you can invest a portion of your portfolio in growth-focused investments to help you grow your wealth faster. Later on in life, what you do is you start to slowly sell off those investments, those growth investments that you really purchased to gain crazy amounts of capital appreciation. Slowly start to sell them off and then start to purchase dividend income producing assets or cash flow producing assets such as dividends or real estate if you prefer to do so. In other words, you can use growth investments to fuel your dividend income later on in life to help you with your retirement needs when you need it the most. Now, these are 7 reasons to consider investing at least some of your portfolio in growth-focused investments. But it's not all sunshine and rainbows. It's not. There's definitely downsides, and there's still a lot of reasons to also, at the same time, be investing for dividends, as I'm about to show you. And let's look at some examples on screen when one beats the other. Okay, let's look at a few examples on screen, and I wanted to show you guys these because you're going to see there's times when growth-focused investments greatly outperform dividend investments, and you're going to see the opposite of that is true. So just depending on what the market's doing is going to determine which investment strategy is currently doing better. And so we have here, where I'm comparing Amazon, one of the most popular investments of all time. Here we go. So over a 5-year time horizon, in the past 5 years, Amazon has grown 410% versus American Waterworks. Now, American Waterworks is a very large blue chip utility company, and I own American Waterworks in my portfolio. It's one of my best investments. As you can see, though, over a 5-year time horizon, American Waterworks has appreciated only 146% versus Amazon 410%. But what happens, though, as the market conditions change? So if we go to that was a 5-year time horizon. Now we're looking at just a 1-year time horizon. The tables have really turned. Look at this. You wouldn't think that a utility company could beat Amazon out, but it definitely can. So within the past year, American Water Works has gone up 41%, whereas Amazon has actually lost 8% roughly. Or let's look at another example. Let's look at, how about we compare Facebook over a 5-year time horizon against some popular blue chip dividend paying companies. So Facebook is the dark line in blue, which is appropriate for their website's color and brand. And then we're also comparing that against McDonald's, Coca-Cola, and Pepsi. So McDonald's, as you can see, this yellow line here, over a 5-year time horizon, you can see that it's neck and neck with Facebook. So really, McDonald's has kept pace with Facebook, which is Facebook's a pure growth stock, pays no dividend over the past 5 years, and McDonald's does pay a 2% something dividend every single year. So it has performed very nicely. And then Coca-Cola, the Coca-Cola's in red here. That's only appropriate, right? 30% over 5 years, and Pepsi is in purple at 45% rate of return. But what happens though if we look at a shorter time horizon? So now let's compare these 4 investments over 2 years. All of a sudden, the market conditions have changed, and we see that Facebook is no longer performing so great, right? So we see Facebook over a 2-year time, in the last 2 years, has only gone up in value about 5%, whereas McDonald's has skyrocketed at 35%, Coca-Cola 19%, and Pepsi 15%. So I just wanted to show you guys these 2 examples, and there's so many other examples that are out there that you can look at, and Yahoo Finance is a great tool to do that, of when you can see how growth investments, when they can beat out dividend-paying investments, and vice versa. So these are just things to be mindful of when you're thinking of investing in dividend-paying, having a dividend-focused strategy versus a growth-focused strategy. Just know that both can work. It really just depends on what the market's doing. From my personal experience, I have found that companies that have both a growth feature and an dividend income feature can do very, very well in certain market conditions.
So, Mike, this is great and all, but how much should one put in growth-focused investments versus dividend income investments?
Great question, Chipper, but really the answer just depends on each person. It's totally up to the investor, depending on their overall investment goals and their risk tolerance. Now, personally, my personal allocation currently between dividend income-focused investments versus growth investments is about 65-35. So whereby I have 60% of my investments in companies that pay out some sort of dividend, and the other 35% focus in companies that are more focused on growth. However, if you factor in my 401k, then it becomes closer to 50-50, because within my 401k, I focus purely on growth and nothing to do with dividend income. All of my dividend income focused investments are over in our brokerage accounts, our taxable brokerage accounts, and my wife and I's 2 Roth IRAs. And I want to grow that money as quickly as possible within my 401k, especially with all the included employer match, because later on in life, what I would like to do is slowly convert that 401k into either a Roth IRA or start to slowly convert that money into purchasing dividend-paying assets or cash flow-producing assets. Okay, now for that bonus I mentioned, if you stuck around, I really appreciate it, and here it is. These are currently, as of August 30th of 2019, and these things switch out every now and then because of the market, but these are my 10 best performing investments currently as of this year within my taxable brokerage account. As you can see from this list, I'm glad I invest both for dividend income and for growth. Now, although Amazon has been a huge winner for me, my dividend-paying blue chip stocks this year have really outperformed Amazon and some of my other growth investments in 2019 because of changes in the market. And speaking of changes in the market, let me leave you with this. So, there's going to be some years where your growth investments just slaughter, and I mean slaughter the performance of your dividend investments, okay? But there's going to be other years where your dividend investments greatly outperform the growth investments. So it's great to have both for adaptability. And remember, there's no such thing as a growth stock. There's no such thing as a dividend stock. There's only stocks. There's only ETFs. There's only mutual funds. But the dividend income and growth are 2 different strategies. And depending on what the market is doing, it's nice to have a mix of these things so that your overall investment strategy is more adaptable to what the market's doing. Because we always have to be nimble, we have to be flexible in order to have success. And I find that especially to be true in investing. So those are reasons I think overall my philosophy is to have both growth and dividend income focused investments within your portfolio. How much you want to put in each is totally up to you. If you have a long investment time horizon, you might consider investing anywhere from 30 to up to 70% of your portfolio into growth investments. Or, if you want to copy what I do, you could do like a 70-30 split or a 65-35. It's however you want to do it. It's totally up to you. And Kevin O'Leary, the guy from Shark Tank, I think I saw him speak at a conference, and he is primarily a cash flow investor. And so he put 70% of his investments into dividend-paying assets, where the other 30% is in growth. As I mentioned earlier in the video, if you want to learn more about this topic of whether you should invest for dividends or if you should be investing for growth, I highly encourage you to check out these articles. I read through all of these things before I actually produced this video, and I think you're going to find some really nice insights within these articles. I have a few articles from Seeking Alpha. There's an article from the Financial Samurai that talks about dividend investing for younger investors versus investing in growth. And then I have other articles from Seeking Alpha as well that I think it will be worth your while if you don't read the full thing, but if you at least skim it. I think it's going to give you some more insights in terms of helping you form a strategy for yourself. All right, guys. Well, I hope you enjoyed today's video. That is all the information I have for you today. If you did, make sure you drop a like. And if you're brand new to the channel, I just want to say welcome. Here at Money and Life TV, our goal is to help you become fiscally fit. And we do that by teaching finances, investing, taxes, and more on a regular basis. So make sure you're subscribed so to not miss any of our future uploads. Well, guys, thank you so much for sticking with me. This video has been a lot of fun to make. I really look forward to interacting with you in the comments. Have a great week. Live life uncaged. And I'll see you next time. Bye, guys. Love y'all. Peace.